Jigar Mistry joins in. Jigar, historically it is said that these times of uncertainty are the best times to deploy your capital. But at the same time, it's also the time when emotions are running fairly high. So people are suggested that they stay on the sidelines. What are you doing? What are the clients asking? And what is your investment strategy going to be from here on for the next couple of days?
Yes, Mangalam, good morning. They're quite testing times, so to speak, but the way in which we are seeing this is to sort of fall back on the hard data as much as we can, right? Because it's easier otherwise to get so much sucked into narratives that it ends up becoming a more emotional war rather than sort of the number situation that we are handling. So if I looked at, say, around September, then your sort of EPS and share price growth differential was a fairly large one. However, sort of as we start looking at it around the month of March, we realize that the EPS and share price growth across the large caps and the small cap indices had broadly aligned fully. At that juncture, the rally that we've seen in April so far is a bit of a dislocation that's been developing again. And should sort of this correct, we are already at equilibrium. Now we realized, last year the markets had pulled quite towards the right, at which case you essentially have now come to an equilibrium. And if you go further down the equilibrium on the other direction, you would treat that as an opportunity to get a little more aggressive as far as the India story is concerned.
All right. Hi, Jigar. Good to see you on the show, Jigar. But what's the strategy? Ahead of this event, a lot of domestic participants were actually raising some cash, waiting to deploy for this particular event. As a percentage of all the money to deploy it?
Right, Nigel. So to give you the number first, we are at around 15%, which is an elevated level sort of compared to our history as well. That sort of will get deployed in 2 or 3 sectors, which we think are reasonably decent beneficiaries, irrespective of how this plays out or how long it takes. I think the direction is quite clear from what we are hearing. Chemicals stands out, pharmaceuticals stands out, cement stands out, as we spoke, I think, last week. So those are the sectors incrementally, and if sort of FIs take to a bit of selling again, given that they've built up a lot, currency has helped them in the process, and financials get offered at a better valuation. Then these 4 sectors, chemicals, pharmaceuticals, cement, irrespective, and financials at a little lower valuation.
All right, chemicals, pharmaceuticals, cement, and financials. What do you sense the institutional capital?
To a large extent is long-term capital. Now, the way sort of I would sort of second guess what foreign institutional, and although it's not one cohort, but regardless, see, it's a bigger call on allocation. Now, we have seen almost 15 years of developed markets strength being sort of displayed. Typically, we used to talk about a decade each, so a decade for developed markets, a decade of emerging markets. And this time around, given the Magnificent Seven and the strength that they have shown, the allocators at the international money management firms were not really that gung-ho on emerging markets, With the dollar sort of weakening the way it has from 110 down to below 99, if memory serves, then you essentially are seeing, a lot of money being made just on the currency. Given Indian markets are a little more expensive, even given its own history, much more expensive in the regional context, but you don't really find a market which is, say, $3.5 trillion going to $5 trillion in GDP, a reasonably well operating democracy, strong judiciary, a very large consumption market. You may have, say, Brazil, which is largely commodity. You have Saudi, which is largely oil and not as big consumption markets. So eventually, given the right price, a lot of capital would come to India. Domestic savings, right? We, at the peak of Harshad Mehta sort of scam, we had domestic savings coming into equity at 15%. In 2014, that number fell to 0.7%. Today, it is 4%. Should it go to 10%? We are talking about 10 lakh crores of flows coming into mutual funds. So these are quite large numbers in terms of flows. Whatever shape and form this conflict takes, 2014, that number fell to 0.7%. Today, it is 4%. Should it go to 10%? We are talking about 10 lakh crores of flows coming into mutual funds. So these are quite large numbers in terms of flows. Whatever shape and form this conflict takes, it will sort of, obviously, we are all hopeful that who the winner stands in these situations. But the cost of the conflict might differ the sort of market reaction to this. But net sort of India emerges as the winner, and a lot of money, my sense is, would flow towards it.
Indeed, net, for a nation on the whole, as well as from a stock market perspective, India will emerge stronger. Final question, Jigar, before we let you go, what's the exposure you'll have to defense? That's one segment of the market that's actually doing well in today's trading session. There will have to be more amount of ammunition that will have to be procured to refill what was already there as well. So that's why you have defense stocks that are doing well. What is your exposure, and will you look to be increasing your allocation?
Right, Nigel, we have some exposure. A lot of these stocks had started discounting a lot more around August, September 2024. Plus, sort of all the victory that, we don't really know how much of it is true. But the entire loitering munitions, the entire defense systems, we have a lot to thank to the DRDO. I don't know a lot of private sector has been able to participate as well as we would like in the future. So clearly a lot of, ground to cover. We don't as of now think that, those opportunities are fully priced in at the moment. So we'll be on the lookout for sort of, increasing allocation in this sector. But we don't have a lot at the moment. We have some exposure, but not a lot.
Take that point, Jigar. Thank you so much for joining in and giving us your views on the markets. Not particularly perturbed about what is taking place if you're in sectors like cement, your sectors in